good afternoon, class, or good morning, or good evening. How are you? It's been a while since I had the opportunity to visit with you. Anyway, wherever you are, I hope you are well. Today we will cover the first half of chapter 7, and chapter 7 deals with the futures and options on foreign exchange. So this is what the chapter covers, and I will talk about futures contracts. I'll give you some preliminary information. We'll talk about currency futures markets, some basic currency futures relationships. We'll talk about options. Okay, we'll talk about currency options, currency futures options, and we'll discuss some basic option pricing relationships. We'll talk about American option pricing relationships, European option pricing relationships, and we will briefly discuss the binomial option pricing model. We'll talk about European option pricing models, and finally, I would mention a few empirical tests in this area. Okay, so without any further delay, let's get started. Futures contracts. Okay. Both forward and futures contracts are derivative or contingent claim securities. Why? Because their values are derived from or contingent upon the value of the underlying security. In case I forgot to mention this to you, I have done a lot of research in the area of futures and options. This is one of my favorite areas. And if you're interested, I'm always glad to share my research with you. So just let me know if you're interested. Now, there are some significant differences between forward contracts and futures contracts. Now, forward contracts are tailor-made or customized for a client by their international bank. Say, for example, you are based in Windsor and you are conducting business with some company in Japan. So at some point in time you would need some Japanese yen to take care of some business in Japan. So you can approach your bank to negotiate a forward contract with the bank. In so doing, you are able to lock in an exchange rate today. So that eliminates any risk that the Canadian dollar may lose value between now and when you will actually need the Japanese yen. So again, these contracts are tailor-made or customized. And most forward contracts are not exchange traded. The lone exception is the forward contract. What about futures contracts? Well, futures contracts are highly standardized in terms of their features. That is, the contract size is clearly specified, the maturity date is known with a certainty, the delivery months are also specified, and the quality of the underlying asset or commodity is also clearly specified, as you are about to see in the next couple of slides. Now, unlike forward contracts, futures contracts are exchange traded. Okay, they are exchange traded. Now, here's one example of a euro futures contract. So contract specs stands for contract specifications. Okay, and these specifications apply to both futures and options on the euro. We are looking at this from the prism or from the standpoint of a US-based investor. So look at the contract size, also known as contract unit, is for 125,000 euros. What does this mean? Well, what this means is that if you sell this contract, then you are taking on the obligation of selling 125,000 euros, right? Yeah. Now, on the other hand, if you buy this contract, then your obligation is to buy 125,000 euros. So you can see that the size is clearly specified, right? Everything else is clearly specified. The settlement method consists of exchanging the underlying asset unless you have reverse traded. Now, what do I mean by reverse trading? Reverse trading means if you take a long position by buying a futures contract, you can get out of your obligation by selling that contract. If you initially sold the contract, again, you can eliminate your obligation by buying the exact same contract back, right? That nullifies your responsibility vis-a-vis the market. Now let's look at another futures contract. This one is for a crude oil. This is the West Texas Intermediate. Okay, this is a light sweet crude oil blend, where light refers to its low density and sulfur content, ideal for conversion to gasoline and diesel fuel. Okay, so again, the contract size is 1,000 barrels. So if I purchase this contract, I have taken on an obligation to buy 1,000 barrels of this particular type of crude oil. Okay, if I sell the contract, then again, my obligation is to sell 1,000 barrels of this particular crude oil at some point in the future. Okay. So again, this is what we mean by these contracts are highly standardized. Let me show you yet another one. Okay. This contract is for corn. Okay, as of March 2019, the corn to be delivered had to meet these requirements. It had to be number 2 yellow at contract price, number 1 yellow at 1.5 cents per bushel, and on and on and on. You can see that again, the contracts are highly standardized, and the contract size is 1,000 bushels of corn. So if I buy this contract, then I have to buy 5,000 bushels of corn. Or if I sell this contract at some point in the future, I need to sell 5,000 bushels of corn, unless again I reverse trade. Reverse trading means that you do the opposite of what you initially did. So if you initially sold the contract, you have to buy it back. If you initially bought the contract, you can get out of your obligation by selling that contract, by selling the exact same contract. Okay. Now, the major difference between a forward contract and a futures contract is the way the underlying asset is priced for future purchase or future sale. Okay. Before you proceed, I ask that you please cut and paste the following URL, okay, into your browser's address bar to learn more about the different facets of futures trading. This is something that you will certainly enjoy. So do this, okay, and then come back to the recording. On January 27th, 2021, that is very recently, the Commodity Futures Trading Commission, CFTC, this is in the United States, right? This is the entity that regulates the futures markets. So the CFTC adopted a revised regulation 39.13 and so on and so on. You don't need to memorize this, related to consumer margining. Okay, this particular regulation eliminates the existing reference to hedge positions, which serve as a baseline for determining whether an account is considered a hedger or a speculator. Prior to this regulation being adopted on January 27, 2021, it was absolutely mandatory that customers be classified in terms of whether they are hedging or whether they are speculating, okay, for the purpose of determining the amount of the initial margin that they would deposit when taking a position in futures markets. Okay, a hedger is somebody that has something or that is interested in the underlying asset. For example, if you are a wheat or a corn grower, then you have clear interest in corn or in wheat, because that's your livelihood. Now, a speculator is one person, is a person that has no interest in the underlying asset. So why are they in the market? They're just trying to take advantage of price changes. Now, for example, your instructor, I buy and sell the futures contracts on oil-related products. By that I mean crude oil, unleaded gasoline, home heating oil. I have no interest in those assets, right? So why do I buy and sell them? Well, I buy and sell because, again, I want to take advantage of price fluctuations. Yeah. So whether, these categorizations, that is whether you are a speculator or a hedger, in turn drive whether a client account qualifies for the maintenance performance bond level or the higher initial performance bond requirement level. Now, under the revised regulation that I mentioned earlier, which was adopted just last month, the clearing members must determine whether an account has a heightened risk profile or not. Accounts which the clearing member determines present a heightened risk profile will be subject to the higher initial requirement level. Accounts which the clearing member determines do not present a heightened risk profile will be subject to the maintenance requirement level. And I will show you on the next slide what all of this means. Yeah. No, not the next one, the one after this. Okay. Margin requirements, there are two types. There are two different types of margin that a market participant should be aware of. An initial performance bond must be deposited into a collateral account to establish a futures position. And you do this whether you're buying the futures or selling the futures. You need to come up with an initial deposit, also known as the initial performance bond. The initial margin or initial performance bond is the upfront payment, usually stated as a percentage of the trade price. And you have to make that deposit prior to a market transaction when purchasing or selling, not just purchasing, when purchasing or selling on that margin. Now, the initial margin is typically equal to about 3 to 12% of the value of the contract. And you can satisfy this requirement by either putting up cash or treasury obligations. Okay. Now, after the initial margin is met, a market participant is required to keep up maintenance margin. This is the amount of equity required to retain an open position. If subsequently margin equity falls below the maintenance margin level, a call must be issued to bring the account up to its initial level. Now, this is the concept of heightened risk profile, which I mentioned earlier, or HRP, as it is known in the profession. Okay? So heightened risk profile initial margin requirements for all products are currently, that's as of February 2021, set at 110% of the maintenance margin requirement for a given product. Non-heightened risk profile initial margin requirements for all products are set at 100% of the maintenance margin requirement for a given product. And I will show you very quickly what all of that means. Now, here's one example that I took from the Chicago Board of Trade. The Chicago Board of Trade is a branch of the Chicago Mercantile Exchange. Okay, so the following table shows the aforementioned logic in practice. Yeah. Now, the non-heightened risk profile initial margin on the Chicago Mercantile Exchange March futures contract is set at 1,500, while the heightened risk profile initial margin requirement is 110% of that. That is, if you take 1,500 times 1.1, you get 16 50. What does all of this mean? Well, if your broker determines that you are a risky investor, okay, and then if you wanted to buy or sell this particular contract, they would have you deposit 1650 initially. Yeah. They'll have you deposit 1650 if you have a heightened risk profile. Otherwise, they will charge you only $1,500, and this is based on the current initial margin. So this is where the current initial margin on corn is right now, and this is corn on the Chicago Mercantile Exchange. So they come out and tell you right from the get-go that, hey, look, now if you are going to buy or sell futures contracts on corn, the minimum initial is 1,500. Okay. Now, if your risk profile is about average, then that's what you're going to end up paying, the $1,500. However, if you are determined to be above normal, if your risk level is determined to be above average, then they'll have you pay 1,000. The difference between these two is 1,250 or 1,150. At any rate, they'll have you pay this much more. They'll have you pay this much instead of 1,500. So that's the distinction between the two types of investors. Okay. Now, recall that the corn futures contract traded on the Chicago Board of Trade, I was showing you this earlier, is for 5,000 bushels of corn. As of the closing, or as of the close of business on February 25th, right, 2021, corn was trading for about $5.42 per bushel. Therefore, the notional value of one corn futures contract is 5,000 bushels times $5.42 a bushel, so you get 27,000. So this is the notional value or the face value of a corn futures contract on the Chicago Mercantile Exchange, 27,100. Now, if you buy this contract or selling this contract, you only have to come up with a fraction of it. Okay? As we saw on the prior slide, okay, if you are a non-heightened risk investor, you will only have to come up with $1,500 as a percentage of 27,100. That is 5.54%. Okay. Now, if you are a heightened risk profile investor, then your initial deposit is 1,650 divided by 27,100. So that's how much you have to deposit initially, whether you're buying or selling this particular contract. Another concept, another important concept in the futures market is known as variation margin. Now, what is variation margin anyway? What is variation margin? Well, the term variation margin refers to a margin payment made by a clearing member, such as a brokerage house, to a clearing house based on the price movements of futures contracts held by the clearing house member. Now, clearing members are required to pay variation margins on a day-to-day or an intraday basis in order to reduce the risk exposure of high-risk positions carried by clearing houses. Thus, collecting variation margin from its members enables a clearing house to maintain the overall risk exposure at suitable levels, such that orderly payments for all traders are facilitated. Now I'm giving you an example of variation margin. I say consider a situation where a trader purchases a futures contract. On the contract, the initial margin, which is the minimum capital required in order to execute a trade, is, let's assume, 5,000. Now, the maintenance margin may be 4,000, which means that at any given point in time, the equity position of this trader must be no less than $4,000. You know, it means that if the total account balance falls to 4,000, the trader is required to top the account back up to 5,000. It is because the buffer amount in the trader's account has been reduced to a level that is not acceptable. Okay? Now, the difference between the initial margin and the maintenance margin, in our case, 1,000, is called the variation margin. That is the amount that you have to add to your account to bring the account back into compliance. Yeah. Thus, the variation margin is the amount of funds required to ensure the account reaches a minimum level to ensure future trades or to guarantee future trades. What is a margin call? This is an expression that you might have heard of, especially those of you that trade stocks. Okay, when a broker needs its investor to contribute additional funds to its trading account in order to fulfill the minimum criteria of margin account or margin accounts, a margin call is made. Usually the need for a margin call arises when the equity balance of the account falls under the minimum amount required, such as when an account loses money or takes on additional positions. In case the investors are unable to meet the margin call, the broker must either reduce the risk to an acceptable level or sell some or all of the securities in the account. So they may simply liquidate your account. Now, forward contracts state a price for the future transaction, but futures contracts are set up or marked to market daily at the settlement price. In other words, with forward, forward contracts almost always result in the underlying asset changing hands. Now, that's the case with forward contracts. Now, with futures contracts, though, these contracts are marked to market on a daily basis. That is, at the end of each trading day, your broker takes a look at your account to see whether you've made money. If you've made money, your account receives credit. If you've lost money, then the amount of that loss is deducted from your account. That is called daily settlement. Now, which price do they use to determine whether you've made money or whether you've lost money? The price which is used in making that determination is known as the settlement price. So the settlement price is a price representative of futures transaction prices at the close of daily trading on the exchange. It is determined by a settlement committee. Many people have criticized this approach, right? Because it's not really a market-driven or market-determined price. Instead, the settlement price is determined by a committee. Yeah, it is determined by a committee. So it may be somewhat arbitrary if trading volume for the contract has been light for the day. So a committee comes up with a price which is used to determine whether or not you made money. Again, he has sort of summarized the differences between futures and forward contracts. Okay, trading location with futures, okay, you're looking at organized exchanges. When it comes to forward contracts, okay, they are traded by bank dealers via a network of telephones and computerized dealing systems. Contractual size. For futures, it is standardized, right? And for forward, we made a point earlier that the size is tailor-made. or customized. And you can read the rest here. Currency futures markets. Now, trading in currency futures began on the Chicago Mercantile Exchange on May 16, 1972. By 1979, we had about 2 million contracts trading. By 2018, that number had ballooned to 230 million contracts. Now, the Chicago Mercantile Exchange Group formed in 2007 through a merger between the Chicago Mercantile Exchange and the Chicago Board of Trade. In 2008, the Chicago Mercantile Exchange Group acquired the New York Mercantile Exchange to form the biggest futures market in the world. Most Chicago Mercantile Exchange currency futures trade in a March, June, September, and December expiration cycles out 6 quarters into the future. In other words, at any given point in time, you have a contract out there that is maturing in March, then you have another one maturing in June, September, December, and 6 additional quarters out. Okay, with the delivery date being the 3rd Wednesday of the expiration month. And the last day of trading for most contracts is the 2nd business day prior to the delivery date. Now, trading takes place a Sunday through Friday on the Globex, a trading system, from 5 p.m. to 4 p.m. Chicago time the next day. Currency futures trading takes place on other exchanges in addition to the Chicago Mercantile Exchange. Information provided on quotes for the Chicago Mercantile Exchange futures contracts includes the following. They give you the opening price, they give you the highest price of the day, the lowest, they give you the settlement price. This is the price that we were talking about earlier, which is determined by a committee. And it also gives you something known as open interest, okay, where open interest is the total number of short or long contracts outstanding for the particular delivery month. So if you're looking at the month of March, for example, we are in February. So if open interest is given as 500, it means that you have 500 contracts out there that have not been reverse traded. You have 500 contracts standing or outstanding. Okay. Futures prices are very similar to forward contracts, although they have significant differences. Yeah. I'm showing you a few quotes here. The first one deals with the Australian dollar futures. This is vis-a-vis the US dollar. So we're looking at futures here, and we're looking at options here. Okay, on the Globex that I mentioned earlier, we had that many contracts. And that's the volume, the trading volume, that's the number of contracts changing hands in one trading day. And open interest, which was discussed just a few seconds ago, open interest gives you the total number of contracts that are still standing, that are still outstanding. Okay. You can see that open interest is always going to be greater than daily volume. Now, this is the basic currency futures relationship. Okay. Recall from chapter 6, the interest rate parity model states that the forward price for delivery at time, the T, is given as shown here. We saw this in chapter 6. We will use the exact same equation to define the futures price. Okay. We will use the exact same equation to define the futures price. That concludes the first half of chapter 7. I'm going to come back to you with the second half, which deals with options.